The name of the reading is market efficiency. And the whole idea of this reading is what we are trying to understand with this reading. Let us say the price of a stock right now, market price of a stock right now, let us say is $100 per share. Now a set of new information is made available by the company. So maybe it could be a quarterly earning review, or it could be earning guidance. Now this new information should increase the price of the stock to 120. That means it's a positive information. The price should increase to 120. Market efficiency essentially will guide you in how quickly this 100 will become 120. So if this 100 becomes 120 within seconds, that means immediately the market prices absorb that new information. We will say that markets are highly efficient. But if this 100 became 120, let's say within a month's time, then we will say that markets appear to be relatively inefficient because markets took a lot of time to absorb that new piece of information. So, market efficiency or efficient markets. In an informationally efficient capital market, security prices reflect all available information fully, quickly and rationally. If the markets are efficient, it would result into quicker reaction to new information. And this part is extremely important, that it is only the unexpected information which is going to elicit a response from the traders. Okay, so what does it mean? So we are on to the McDonald's page of Reuters. We have been given sales. Is it in millions? Yeah, sales in millions. And can you observe this particular number? 24097. This is the sales for year ending December 2016. Right now we are in 2015. That means this December 2016 is a forecast. And how have they arrived this forecast? This is the average forecast value, mean value or average forecast value of the sell side research analyst tracking McDonald's stock. Now, the fact that the sales is going to be 24097 should be already factored into the price of McDonald's today. So, when the actual results come out, and if the actual sales turns out to be, let us say, 28,000, that means it turns out to be more than what was originally estimated, then this would be considered as a positive revenue surprise. A positive surprise. And since it is a positive surprise, the markets will react to it positively. But if the actual sales turns out to be, let us say, 20,000, then it would be considered as a negative surprise. But if the actual sales turns out to be exactly 24097, then the markets will not react to that information because that expected value is already factored into the current market price. Are we clear with this component? So, we will look at that sentence again. It is only the unexpected information, which means a surprise, which is going to elicit a response from the traders. So what should be the appropriate strategy? Highly testable sentence. First, we'll read through this carefully. If the markets are fully efficient, active investment strategies cannot earn positive risk-adjusted returns consistently. Can you help me understand what does this mean? So, two types of investment strategies. First one is passive. Second one is active. So the easiest way you can think of passive is to simply invest in proportion set as per an index. So for example, S&P 500 or Nifty or Sensex in India. So you invest exactly in the same proportion. Whereas what active investment strategy will essentially tell you is that you can invest, you can overweight certain securities, you can underweight certain securities. That means you yourself decide which securities to invest which securities not to invest. Now, if the markets are fully efficient, then you would not be able to find any security which is overvalued or any security which is undervalued, because the efficient market will tell you that all securities would be fairly priced. And then whatever amount that you would spend trying to find overvalued and undervalued securities, that cost will reduce the total returns that you would have otherwise earned by simply investing into a passive security. So therefore, the sentence which says that if the markets are fully efficient, active investment strategies cannot earn positive risk-adjusted returns consistently. Are we good to go ahead? An investor therefore should use a passive strategy. Next learning outcome discusses about the difference between market price and the intrinsic value. Market price means the price at which stock is trading in the market, and this is purely determined by the interaction of demand and supply, which in turn is affected by thousands of variables. Intrinsic value means the fundamental value. An alternate word that we use is also justified value, and the easy way to think of this is the true worth of that stock. So that is called as intrinsic value. So this market value is available simply by looking at any of the database website or a exchange website. Okay, so this is where you can fetch this market value. Intrinsic value, you will have to find it out by doing some research. So you can either find this in a equity research report, or you can yourself build a valuation model. Now, market price is only one, which means at any point of time there's only one market price. However, every analyst will have a different estimate of the intrinsic value. So it is quite possible that market price of a stock is 50 and there are three different analysts and they have calculated intrinsic value. The first analyst would say that intrinsic value is 90, second one 50, and the third one is 30. So the same stock, but the first one will say that the stock is undervalued because intrinsic value is more. He will say stocks are fairly valued, and the last one will say stock is overvalued because the market value is more than the intrinsic value. So market value means the current price. Intrinsic value, also called as fundamental value, value that a rational investor, no one knows where this investor is, but a rational investor with full knowledge would be willing to pay for that particular stock. So in efficient markets, this is something you should write down. In efficient markets, market value would be same as intrinsic value. In efficient markets, market value would be same as intrinsic value, and therefore expected return would be same as required return. Expected return would be same as required return. Can you help me understand what this means? What is the meaning of expected return would be same as required return? Let us say we are looking at a listed stock. Let's call it as X, Y, and Z. Now, this is an investor who is willing to invest into this stock. So first he will try to determine what is the risk of the stock. One way of determining that risk is beta. So he will identify what is the beta. Let us say beta is 2. What is the risk-free rate of return in the market? Let us say 10%. What is the equity risk premium? Let us say 5%. Using this, we can use a CAPM model, capital asset pricing model, and we can say required return is equal to RFR plus beta into equity risk premium. So in this case, that would be 10 plus 2 into 5, which would be 20%. Now, how do you read this 20%? From the investor perspective, this 20% is what he should earn at minimum to justify the risk in the stock. Do you agree with this? So this 20% would be called as the required rate of return. Required return. That means how much investor should earn. Now, how much investor should earn does not mean this is what he is going to earn. So now what he will do is, he will take this stock and he will build a financial model on this. Financial model is typically built so that you can perform a valuation. So then he will do a valuation, and let us say after his valuation he will come to a conclusion that current market price is 100. After 1 year you are expecting that market price of the stock might become 120. So this 20% now that we have calculated, this is called as the expected return. So required return means what is required to justify the risk. Expected return means what you are expecting to earn out of that stock. Are you following this? And if the markets are efficient, then the required return and the expected return are going to be same, which is same as market value being same as the intrinsic value. No, so in efficient market, you buy any stock, the return that the stock will give you would be at par with what is required. Expected return is forecasted return. Absolutely. Yes. So even required return for every analyst would be different, because we know that CAPM is just one of the model. Right? There are 10-15 different models. So in theory, what efficient market says is, if the markets are efficient, then the expected return and required return should be same. Now, are you done writing this part? Now, if expected return is more than required return, then we will typically say that the stock is undervalued. Why? Because you are expecting to earn more than what the risk of the stock justifies. But if expected return is less than required return, that means required is 20%, expected 25 here, and expected 17 here. So if expected is less than the required return, you are earning less, that means the stock is overvalued. Are we fine? Okay. Next learning outcome. Heading would be factors affecting market efficiency. First, we will look at the positive factors. Number 1, large number of market participants. So do you think it is good for a market to have large participants? Yes, more the number of participants, higher the probability of price reflecting its intrinsic value. Second, greater information availability. More information available, mostly with developed markets, greater efficiency. A lot of emerging markets, so I was working with one client in African region, and their requisition was we had to help them in building certain financial model. But one big difficulty that we were facing was to fetch the relevant set of data. So a lot of emerging markets, you would realize that the disclosure requirements are not so stringent, and therefore data is not available. And if data is not available, then the markets will become inefficient, because you will not be able to calculate intrinsic value. The negative factors. Number 1, impediments to arbitrage. Can you tell me what is the meaning of this? Prohibiting arbitrage. Putting restrictions on arbitrage means making riskless profit. So imagine there are two markets. Okay, so in India we have 2 exchanges. So there are multiple exchanges in multiple countries. Let's say stock price is $50 in one exchange and hypothetical $65 in other exchange. It doesn't happen that way. But what if it is this way? Then ideally what someone would want to do is, he would want to buy at a price of 50 and sell at a price of 65 immediately and earn arbitrage profit. But what if the regulator comes with a rule saying that doing this type of trade is not allowed? If it is not allowed, then that market inefficiency will not be corrected. So therefore, if there are restrictions to arbitrage transaction, then the markets will become inefficient. Is that fine? Second point, impediments to short selling. So again, understand this. Let us say the current market price of a stock is 100. So this is the market price. Intrinsic value of the stock is 150. Now, if everyone in the market agrees that intrinsic value is 150, then everyone will start buying the stock. And if everyone starts buying the stock, then demand will increase. And if demand increases, then it's a self-fulfilling prophecy. It will push the prices towards 150. That means it will make the markets efficient. Now see the other way around. Let us say current market price is 100. Intrinsic value is 50. So if everyone in the markets agree that intrinsic value is 50, then they should be allowed to short sell. And if short selling is allowed, then the supply in the market will increase. And if supply in the market will increase, then the prices will come down and they will reach to the intrinsic value. But what if there are prohibitions or restrictions to short sell a stock? If there are restrictions to short sell a stock, then the supply will never increase. And if the supply never increases, the market price will never reach to the intrinsic value. And therefore, impediments to short selling is considered as a negative variable. Is that fine? Then next one, high cost of trading and gathering information. So again, if the trade size is very high, then people will not try to exploit arbitrage of smaller amounts because the transaction cost will eat up, and again it will lead to market inefficiency. Will you be able to remember these points? Have you understood the last one completely? Okay. Next learning outcome. Now we have to understand the three separate forms of the market inefficiency: weak form, semi-strong, and strong form market efficiency. Now first understand what is this. This entire work is coming from the research work of a professor called Fema. I might have pronounced it wrongly. And the whole idea is that with his research paper or his hypothesis, he's trying to classify the markets into three broad categories. And this is the most important learning outcome of this reading. What you have to remember is how is that each of the market is defined, what are the typical characteristics, what type of information gets factored into the price, and what strategies to use in each market. Okay. So I have prepared a table for this, and once you go through this table, you would be able to answer most of the question. So first one is weak form. What the prices in the weak form market include or reflect price and volume information. That means all price and volume information is already factored into the price. And since it is already factored into the price, what does not work, you will not be able to use technical analysis in this type of market. But you will be able to use the fundamental analysis, and you will be able to exploit if you have insider information, though ethically you would not be allowed to do that. Are we fine with this? So weak form, what it includes is price and volume information. What works is fundamental insider trading. What does not work is the technical analysis. Then semi-strong form. In this type of market, the prices will reflect price and volume as well as all publicly available information. And since publicly available information is already reflected into the price, now what will not work is technical as well as fundamental. So the only thing that will work in this scenario is the having access to the private information. And in the strong form, price and volume, public, private, all the information is factored, therefore nothing will work, and what does not work is technical, fundamental and insider trading. Are we fine with this? Next learning outcome. Now it is a continuation of the same one where we discuss implication of trading strategy of each of the scenario. So if you are in a weak form market, We know what does not work is technical analysis. But what works in weak form? Fundamental analysis. And because fundamental analysis works, you would be advised to use active portfolio management strategy. But in semi-strong and strong form, since fundamental does not work, what you would be advised to use is a passive portfolio management strategy. Are we fine with this? So we'll use active in the first one and passive in the subsequent two types of markets.